Welcome to the deep dive. Today, we're plunging into a really high-stakes story, right at the heart of the AI revolution. We're talking about a company, TSS Inc., that's seen, well, just explosive growth. But the big question is, are its foundations actually solid? Or is this just, market euphoria?
Right. Is it built to last?
Exactly. Today, we're dissecting this little-known Texas-based integrator. We want to figure out if it's truly become indispensable to tech giants, or if maybe its rapid rise hints at something, well, more fragile.
And by the end of this deep dive, you should have a much clearer picture of let's say, the massive potential here, but also the equally massive risks. It's quite a balancing act.
Absolutely. A company right at the epicenter of the AI infrastructure bill.
That's right. So for this deep dive, we've done a comprehensive analysis of TSS Inc. That's NASDAQ ticker TSSI.
TSSI, got it.
Yep. And our insights are based on financial data and market conditions as of August 15th, 2025. We're using the closing share price from August 14th, which was $17.62 as our reference. And our mission today is really a thorough investigation looking at their business model, the management quality, financial health, and what we estimate as its intrinsic value, all viewed through kind of long-term value investing principles. Part 1. So let's start with Chapter 1, Business Analysis, the engine of the AI revolution.
Okay, let's unpack this business then. What exactly does TSS Inc. do? How do they fit into this, incredibly complex world of data center technology?
Well, TSS operates with a, let's call it, multifaceted business model. They provide end-to-end technology services for data center providers. Their whole mission is basically to simplify the complex.
Simplify the complex.
Yeah, and they make money from a mix of things. Product sales, long-term service contracts, some cloud subscriptions, and project fees. But they really have three main revenue segments.
All right, tell us about those.
Okay, first, there's procurement services. This is basically them sourcing and reselling third-party IT hardware and software. Servers, switches, that kind of thing.
Okay, like a reseller.
Essentially, yeah. And it's actually become their largest revenue contributor, made up about 75% of their total revenue in Q2 2025.
Wow, 3/4.
Yeah, and it saw explosive growth surged over 570% year over year. But, and this is critical, it's high transaction volume, but inherently low gross margins, very thin margins there.
Right, okay. Segment 2.
Then you have systems integration services. Now, this is a higher margin segment. It focuses on the complex integration work for OEMs, original equipment manufacturers and other data center customers.
So putting it all together.
Exactly. And this is a crucial driver of their recent growth, especially for these specialized, high-power, AI-enabled server racks. That part grew 91% in Q2 2025. Much better margins here.
Yeah, the third one.
Finally, there's facilities management services. This covers things like the design, project management, and the ongoing maintenance of data centers. It's generally stable, but it has actually seen a bit of a decline recently, year over year.
So it sounds like there's this real tension, doesn't it? Most of that just eye-popping revenue growth is coming from the low-margin procurement side. What does that mix really mean for the company's health, long term?
That's exactly the core tension. The true measure of their long-term health, their profitability, it really hinges on their ability to grow that higher margin systems integration business much faster than the procurement stuff.
Right, shift the mix.
Precisely. If they can shift that revenue mix, it would significantly improve their overall profit margins. They offer these services under an integrated platform, handling the full life cycle things like modular edge services for specialized AI and liquid cooling, data center services for hands-on rack integration, and configuration services.
So they're kind of like an outsourced extension for the big guys.
You got it. For clients like OEMs and cloud providers, it lets those larger companies scale up without massive new capital spending or hiring tons of people.
That makes a lot of sense. Now, they started small, you said, trading over the counter, but now they're on NASDAQ. How do they actually stack up against the really big players in this space?
Yeah, it's been a dramatic transformation. A year ago, their market value was under $10 million. Tiny.
Wow.
Then, explosive growth, they landed this pivotal multi-year customer agreement, and boom, they uplisted to NASDAQ in November 2024. Now they've got a market cap around $441 million.
Huge jump.
Huge. And despite still being relatively small, they've positioned themselves as this critical partner to some major data center tech providers. They're sort of emerging as a niche competitor to much larger players, like Supermicro.
SMCI.
Right. Some investors even see them as a potential, share gain story, maybe taking business from incumbents.
So in this space, Everything's moving so fast. What's their core pitch? How do they win and keep customers?
Their core value proposition is that simplify the complex thing again, delivering custom integration solutions with, as they put it, unmatched speed, precision, and flexibility.
Speed and flexibility.
Okay, yeah, and in the world of AI and high-performance computing, power needs and complexity are just soaring. So rapid, reliable deployment is absolutely paramount. TSS offers a platform, especially for big OEMs, to offload this really complex, capital-intensive work.
So it's symbiotic.
Exactly. Their partners stay agile, focus on their main business, while TSS handles the tricky integration and logistics.
Okay, let's zoom out a bit to the industry itself. What are the big trends driving TSS's growth, and who exactly are they really competing against?
Well, TSS is right in the middle of one of the most powerful growth trends of the decade, the massive build-out of AI infrastructure.
Yeah, you can't miss it.
Right. The demand for AI hardware, high-performance computing systems, it's accelerating like crazy. Enterprises are modernizing, hyperscalers are in, like, rapid expansion investment mode.
So it's huge tailwind.
Massive tailwind for these picks and shovels companies like TSS. Their CEO, Daryl Dewan, said they're squarely positioned to address that demand, and it's still the early days.
But what about competition? You mentioned Supermicro.
Yeah, the competitive environment is definitely challenging. Supermicrocomputer, SMCI, is a much larger direct competitor. Although there is some market chatter, maybe speculation, that SMCI might be struggling a bit, which could potentially open more doors for TSS.
Interesting. Any other significant hurdles,
Yes.
like regulations? Is it hard to get into this business?
Oh, absolutely. The data center industry is wrapped in complex regulations. You've got strict environmental compliance, energy, emissions, waste, then data security, privacy regs like GDPR, plus operational standards like the Uptime Institute's tier certifications for reliability.
So that's a barrier to entry right there.
A significant one. It favors established players, and the barriers in specialized IT integration itself are substantial. High capital needs, remember that new Georgetown plant costs tens of millions.
Right.
You also need highly specialized technical expertise, skilled labor, especially for these new high-density liquid-cooled AI racks. And maybe the biggest hurdle, the trust. You need deep trust to land those multi-year mission-critical contracts with global players like Dell, relationships built over years.
Okay, so given all that, what is their competitive advantage? What's their moat, so to speak?
Well, their moat is, I'd say, nascent, but definitely strengthening. They aren't a household name, obviously, but TSS has built a strong reputation within its niche as a trusted partner to major data center tech providers. That's built on, like, 40 years of operations.
40 years, wow.
Yeah, long history. Now, as a small cap, they lack the broad economies of scale of the giants, but that new Georgetown facility, it might offer some localized operational efficiencies, specifically in AI rack integration.
And are customers locked in? Switching costs.
They seem moderate to high. I mean, onboarding a new partner for mission-critical infrastructure, that's time-consuming, it's risky. The fact they have a multi-year agreement with their biggest customer suggests this is a pretty sticky relationship.
So that relationship is key.
It's arguably their most significant and defensible asset right now. That deeply embedded strategic relationship, widely rumored to be Dell Technologies. That multi-year AI rack integration contract gives them revenue visibility and stability that's pretty unusual for a company their size. That relationship, plus the new specialized facility, gives them a unique edge in the high-end AI server market. Okay, moving on to Chapter 2. Management evaluation, stewards of capital or growth at any cost.
All right, let's talk about the people steering the ship.
Yeah.
What's the management team's track record? Especially considering this, dramatic turnaround you mentioned.
Yeah, the current team, led by CEO Daryl Dewan, he came on board in November 2022. They really do have an impressive track record executing this massive corporate turnaround.
Pretty quick turnaround, too.
Very quick. In a relatively short time, they took TSS from being the struggle-in microcap, reportedly, near bankruptcy, to a rapidly growing NASDAQ company. Key successes. Landing that huge AI rack contract, launching the new Georgetown facility, and navigating that NASDAQ uplisting, it's quite a comeback.
It really is. And they heard the CEO, Dewan, has a particularly relevant background.
He certainly does. He spent a decade as VP of Global Sales and Field Marketing at Dell Technologies.
Oh, okay. That makes sense.
Right. Deep industry expertise, invaluable relationships. That was likely instrumental in landing that cornerstone partnership, wouldn't you think?
Absolutely. And the rest of the team.
The broader management team is also considered experienced. Average tenure is about 2.1 years, which kind of reflects the new leadership brought in for the turnaround.
Okay. How transparent are they with investors? Because I'm thinking about that stock reaction. Huge revenue growth, but the stock tanks. What happened there? How did management handle that?
Well, management generally maintains regular communication, earnings reports, conference calls, press releases. CEO Dewan's public comments are consistently confident, very forward-looking. He talks about capitalizing on this significant and sustained growth cycle in AI. They even raised their full-year 2025 adjusted EBITDA guidance, signaling strong confidence. But you hit the nail on the head. There seems to be a potential disconnect. After that Q2 2025 earnings report, the one with the massive 262% revenue jump, the stock plunged over 23%.
Ouch.
Big ouch. Why? Because, as we mentioned, their diluted earnings per share were flat year over year, zero growth in EPS despite all that revenue.
So the market zeroed in on profitability.
Exactly. It suggests the market is deeply concerned that profitability isn't scaling with revenue. And that's a concern maybe not fully addressed by management's commentary, which tends to focus more on the top line. No signs of ethical issues, mind you, but it definitely highlights a challenge in managing investor expectations.
Okay, so with all this growth happening, where are they actually putting their money? Reinvesting, buying back shares, dividends.
Their capital allocation is laser-focused on funding aggressive organic growth, no question. The biggest decision by far was that huge investment in the new Georgetown facility to scale up their AI rack integration capacity. Fits right in with their goal, be the best AI IT integration supplier in the market.
And how did they pay for it?
They sought external financing. In January 2025, they got a new $20 million debt facility. Then, in August 2025, they did a big public stock offering, raising about $58.7 million gross.
Okay, so debt and equity raises.
Right. And the funds are earmarked for general corporate purposes, including working capital and growth capital. So, directly supporting business expansion. As you'd expect for a high-growth, capital-hungry company, TSS pays no dividend, no history of share buybacks either.
In fact, they diluted shareholders with that offering.
Exactly. The August offering added 3.45 million shares. That strategy clearly prioritizes corporate expansion over near-term per-share value. Pretty typical for a company in this phase, really.
Now, I'm looking at a metric here, return on invested capital, ROIC. It's listed as a staggering 48.19%. That sounds incredible, usually means great efficiency. Is it as good as it looks for TSS?
Yeah, you're right to flag that. It is an exceptionally high figure, suggests amazing efficiency. However, you absolutely have to interpret it with extreme caution.
Okay, why?
Given TSS's very recent history as a struggling microcap, they had a tiny invested capital base, right? And then you factor in the asset-light procurement segment driving revenue. That huge surge in profitability in late 24 and early 25 measured against that historically tiny denominator. It produces a mathematically high ROIC, but it's potentially misleading.
So it's a bit of an artifact of the turnaround.
I think so. As they invest heavily in Georgetown, and now with the new equity from the offering boosting their capital base, that 48.19% is highly likely just a lagging indicator. It reflects a unique point in their transformation. Definitely not a sustainable rate going forward. All right, let's dig into Chapter 3, Financial Analysis, a story of explosive growth and financial fragility.
Okay, let's get into the raw numbers. What are the key metrics telling us about TSS right now? Where do they stand?
Okay, so as of August 15, 2025, TSS's market cap is around $441 million, puts it squarely in the small cap tech sector.
Right.
Now, their revenue growth over the last 5 years, it's just been explosive, a really dramatic shift to hypergrowth.
Give us some numbers.
Sure. After a dip in 2021, revenue went from $54.4 million in 2023 to $148.1 million in 2024. That's huge already.
Big jump.
And then for the trailing 12 months and in Q2 2025, they hit $263.0 million. That's a massive 328.8% year-over-year increase. Just incredible top-line momentum.
Oh, those revenue numbers are absolutely staggering. But, as we keep saying, big revenue doesn't always mean big profits. Are they actually keeping any of that surge as profit? What do the margins look like?
Yeah, you're hitting the core concern again. While revenue soared, profit margins have definitely come under significant pressure. It's that changing revenue mix, right? The low-margin procurement business growing so fast.
But what are the actual margin numbers?
Their trailing 12 months gross margin is only about 12.2%. That's a major compression from historical levels, which were often above 20%.
Wow.
Operating margin is around 4.9%, and net profit margin is just 3.43%. Very thin.
Very thin indeed. And free cash flow, is that consistent?
Highly erratic, actually. It really reflects their journey from struggling business to this rapidly expanding one needing heavy investment. For instance, 2021 was negative $10.5 million. 2022 was positive $14 million. 2023, negative $8.5 million. 2024, positive $6.8 million. All over the place. And while they did report strong operating cash flow of $37 million for the first half of 2025, that figure doesn't account for the big capital spending on the new Georgetown facility. So the final free cash flow number would be significantly lower.
Okay, so the top line looks fantastic, but it sounds like there's real pressure underneath. Profitability, financial stability. Is this growth coming at a big cost to the balance sheet?
It absolutely is. That explosive growth has definitely strained financial stability. It reveals a stretched and, frankly, quite risky balance sheet. Their earnings history, as we noted, is inconsistent net losses in 21 and 22 before returning to profit.
And that Q2 earnings miss, or rather the flat EPS.
Right, the most alarming point for investors. Diluted EPS flat at 0.116 cents year over year, despite that 262% revenue surge. It just screams that the costs of generating that new low-margin revenue are eating up almost all the gross profit. That new revenue is barely hitting the bottom line.
What about debt?
As of June 30th, 2025, their debt-to-equity ratio was exceptionally high, over 200%.
200%.
Yeah, based on $19.5 million in total debt versus just $9.5 million in shareholder equity. Highly leveraged, very risky. But crucially, this was before that August stock offering closed.
Ah, right. So the offering helps there.
Dramatically. That $58.7 million cash infusion will massively increase equity and slash that debt-to-equity ratio in the next quarter. It was a necessary recapitalization, really.
And liquidity. Could they pay their bills?
That was also a concern. Their current ratio was 0.81, meaning short-term obligations were greater than short-term assets. Pretty precarious. Again, it underscored why that equity offering was so necessary, and no dividend, none expected.
Okay, with all these numbers flying around, explosive growth, thin margins, high debt, then a recapitalization. How do we even start to value this company? What's the market saying? And what does your deeper analysis suggest its true worth might be?
Well, as of early August 2025, TSSI was trading at a price-to-earnings ratio around 56.
56 times earnings. Pretty rich.
Yeah, elevated compared to its own history and definitely on the higher end for the IT services industry. It signals investors are pricing in a lot of future growth, well above its peers.
So how do you cut through that?
We use a discounted cash flow, or DCF model.
Yeah.
Basically, it tries to estimate the value of an investment today based on projections of how much cash it will generate in the future. You project free cash flow, estimate a terminal value, and then discount all that back to today's value using a discount rate that reflects the risk.
And what did your DCF model spit out for TSS?
Based on our educational DCF model, the estimated intrinsic value for TSS Inc. is calculated to be somewhere in the range of $14 to $22 per share.
$14 to $22. Okay. And what are the big assumptions driving that range? Because DCF is sensitive to assumptions, right?
Highly sensitive. We used a pretty aggressive revenue growth rate assumption, 40% for the next 2 fiscal years, 26 and 27.
40%. Okay.
Yeah, reflecting that AI boom potential. Then we tapered it down to a more normal perpetual growth rate of 3.0%. But crucially, we applied a high discount rate, a WACC, weighted average cost of capital of 12.5%.
And why so high on the discount rate?
That high rate reflects all the significant risk we've been talking about. TSSI's small size, the extreme stock price volatility, its beta was cited as high as 4.37 in one source, meaning it's way more volatile than the market.
Yeah, that's huge beta.
Right. Plus the huge customer concentration risk and the fragile state of the balance sheet before that recent capital raise. A higher discount rate essentially penalizes the valuation for all those elevated risks. Part 2. Okay, let's move into Chapter 4, Market Sentiment, Hype versus Skepticism.
All right, beyond the fundamentals we've just discussed, what's the actual feeling in the market about TSS? Is it all hype driving this thing, or is there significant skepticism under the surface?
Well, interestingly, TSS operates largely under the radar of mainstream Wall Street research. You don't see price targets from the big brokerage
With
firms.
no analyst coverage.
Very little robust institutional coverage. That means the stock's narrative gets shaped mostly by company press releases and the sentiment of, retail investors and smaller institutions.
And what is that narrative? Is it consistent?
Not at all. It's sharply polarized. It's really a classic battle. Compelling growth story versus some pretty concerning underlying fundamentals.
Okay, lay out the bull case sentiment.
The bullish tone is all about the explosive revenue growth. It highlights TSS's strategic position, capitalizing on the AI infrastructure boom. They point to the new Georgetown facility coming online, management raising adjusted EBITDA guidance. It paints TSS as this high-growth picks and shovels play in AI.
Makes sense. And the bears.
Conversely, the bearish tone really intensified after that Q2 earnings report. Despite beating on revenue, that 23% stock plunge, it shifted the conversation squarely onto the flat earnings per share.
Right, the profitability question again.
Exactly. Profitability, sustainability, the volatility of that low-margin procurement business, and the huge risk of customer concentration. Even the timing of the August stock offering drew negative comments. Why didn't they raise cash when the stock was near its highs?
Good question. Are there any specific market indicators that show us which side, bulls or bears, is kind of winning this tug of war right now?
Yeah, one of the most telling indicators is the extremely high level of short interest in TSSI stock.
Short interest. Explain that.
That's the percentage of publicly traded shares that have been borrowed and sold short by investors who are betting the price will fall. As of August 2025, short interest as a percentage of the float was over 25%.
Wow, more than a quarter of the shares are shorted.
Exactly. That is exceptionally high. It indicates a really significant bearish contingent out there, focused on that weak balance sheet and the, let's say, poor quality of the revenue growth.
And high short interest can lead to volatility, right? A short squeeze.
Precisely. If good news hits, those short sellers might be forced to buy back shares quickly to cover their positions, which can rapidly drive the price up, adding to the stock's already high volatility.
What about technicals? Chart patterns? Moving averages?
From a technical perspective, as of August 15th, that stock price of $17.62, it's trading significantly below its 50-day simple moving average, which was around $23.81.
Okay, what does that mean?
The 50-day moving average tracks the average price over the last 50 trading days. Being below it is generally seen as a bearish signal. It indicates recent negative momentum, sellers seem to be in control, reflecting that sharp sell-off after the Q2 earnings.
But what about longer term?
However, the long-term trend is still positive. That $17.62 price is still comfortably above its 200-day simple moving average, which is around $13.52.
Okay. So short-term bearish, long-term bullish.
Kind of. The 200-day average shows the longer trend. Being above it indicates that, despite the recent pullback, the powerful uptrend that started back in 2024 hasn't technically been broken yet. This posture below the 50-day but above the 200-day puts the stock at a really critical inflection point. It's in a period of correction or maybe consolidation. The battle between those two moving averages will likely define where the stock heads in the coming months. Okay, next up, Chapter 5. Ownership structure. Who is at the helm?
Right, let's look at who actually owns this company. Are the big institutions buying in? And what about the insiders themselves, the management and board?
Well, institutional ownership in TSSI has definitely grown since the NASDAQ uplisting, but it's still relatively low for a public company, maybe around 22.5% to 30% of the outstanding shares.
So not huge institutional backing yet.
Not huge, but growing. The shareholder list has a mix of hedge funds and some large asset managers. The single biggest institutional holder is MHW Capital Management, LLC, with an 11.6% stake.
MHW Capital.
Yeah, and recent filings actually show a surge in interest. 75 institutions increased their positions recently, compared to only 40 decreasing them. So money seems to be flowing in from institutions.
What about insiders? Management, the board?
Insiders also hold a pretty substantial chunk, estimated around 29.4%, and that includes a 2.5% stake held directly by the CEO, Daryl Dewan. Generally, that kind of insider ownership aligns management and board interests with shareholders. You want them to have skin in the game.
That sounds positive, that alignment. But I thought I saw something about insider transactions that looked less positive. A red flag.
You are absolutely right to spot that. Yes, looking at recent transaction history reveals a pretty significant red flag. A consistent and frankly heavy pattern of insider selling.
Selling, how much?
Over the past 12 months, there were 45 sell transactions by insiders compared to only 5 buys. Net, they sold over 1.4 million shares, and this selling has been widespread across the executive team.
That doesn't sound good. The people who know the company best are selling.
Exactly. That pattern of selling by those with the most intimate knowledge, it's a significant bearish indicator. It creates this really clear conflict in signals from what you might call the smart money. Sophisticated institutional investors are buying the story, but the company's own executives, they've been consistently selling shares.
That's a major disconnect. And ownership is pretty concentrated too, right? You mentioned MHW Capital.
Yes, relatively concentrated. The top 18 shareholders own 50% of the business, and the most influential is MHW Capital Management, that 11.6% holder. Now, MHW is founded and run by TSSI's chairman of the board, Peter H. Woodward.
The chairman runs the biggest institutional shareholder.
Correct. And MHW's stated strategy is taking concentrated positions in micro-cap turnaround companies. This context is critical. TSS's journey from near-bankrupt micro-cap to high-growth NASDAQ company. It's a textbook example of what MHW targets.
So the chairman likely orchestrated this whole turnaround.
It's highly probable. The company's current strategic direction, the pivot to AI integration, maybe even appointing CEO Doron, it was likely heavily influenced, if not directly orchestrated, by Chairman Woodward via MHW. Now, his firm's large stake ensures strong alignment with shareholder interests, which is good, but it also means MHW's future investment decisions will have an absolutely outsized impact on the stock's future. Which brings us to Chapter 6, Risk Assessment. A comprehensive SWOT analysis.
Okay, let's pull everything together now. A SWOT analysis looking at TSS's internal strengths and weaknesses and its external opportunities and threats. Give us the rundown.
Okay, a thorough assessment shows a company with, like we said, immense potential, but also really significant vulnerabilities. Let's start with strengths.
Go ahead.
Their most valuable assets are those strategic partnerships, particularly that deep multi-year relationship with at least one major OEM for AI rack integration. That's number one.
Like the Dell relationship, probably.
Probably. They also possess specialized operational capabilities, notably that new 213,000 square foot Georgetown facility, purpose-built for complex AI racks. Then there's the experienced management team with that proven turnaround track record. And finally, their core value prop, flexibility and speed in custom tech deployments.
Okay, strong foundation there. What about the weaknesses?
The biggest weakness is clearly extreme customer concentration. Relying so heavily on one big customer is always risky.
Hugely risky.
Yeah. They also suffer from that unfavorable revenue mix, with most revenue coming from volatile, low-margin procurement services. Their balance sheet was strained before the equity offering highly leveraged, poor liquidity. And lastly, there's been significant shareholder dilution from funding that aggressive growth.
All right, weaknesses noted. What about opportunities? Where can they go from here?
The biggest opportunity is obvious, secular AI growth. They're perfectly positioned to benefit from this massive multi-year investment cycle.
The tailwind we talked about.
Exactly. There's also a significant opportunity for customer diversification, landing more big partners beyond the main one, improving their service mix, shifting more towards high-margin systems integration. That would hugely boost margins. And management has mentioned global expansion, particularly into Asia-Pacific and Latin America, as a strategic priority.
Okay, lots of potential upside. Now, the threats. What could derail this?
Threats include competition from larger, more established players, obviously. There's the constant risk of technological obsolescence. Data center hardware changes fast, requiring continuous investment. Supply chain disruptions like GPU shortages could hit projects and costs. And, of course, macroeconomic factors, high interest rates, uncertainty could make customers delay big spending plans.
Makes sense. Anything else specific?
Yes, and here's where it gets really interesting, maybe concerning.
Oh.
A particularly significant external threat right now is the U.S. imposed tariffs of 2025 on IT hardware and components imported from places like China.
The trade war impact.
Right. These tariffs have led to price hikes, maybe 5% to 20% on things like servers and networking gear. This directly hits both of TSS's main business segments. For procurement, it squeezes those already razor-thin margins even more.
And for integration.
For the higher margin integration segment, increased component costs could raise overall project prices. That might cause customers to delay plans or scale them back. This trade policy is a major external margin risk, pretty much outside of TSS's control.
So, pulling that SWOT together, strengths, weaknesses, opportunities, threats, What does it all mean for someone looking at TSS as an investment? What's the core dynamic here?
Look, the entire investment thesis for TSS, when you boil it down, it really hinges on that one single powerful strength, their ability to flawlessly execute those high-margin AI integration services for their key strategic partner. Everything else is secondary.
It all comes down to that one relationship and execution.
Pretty much. Conversely, all those numerous and significant weaknesses and threats we just listed, the fragile balance sheet, the customer concentration, the impact of tariffs, they all directly endanger that central pillar of the bull case. So, investing in TSS, it requires an exceptionally high degree of conviction in the durability and the profitability of that single critical customer relationship. Which leads us to our final chapter, Chapter 7, Conclusion.
Okay, so we've broken down TSS from just about every angle. Let's crystallize the bull case versus the bear case. What are the key takeaways for each side?
Right. The bull case for TSS Inc. is admittedly a compelling story. You've got this small, agile company, seemingly perfectly positioned right at the epicenter of the AI revolution. They provide essential, complex integration services critical for deploying AI infrastructure.
Built on that key partnership.
Exactly. Built on that strategic partnership with a major OEM, providing stable, high-margin revenue, plus they have the new state-of-the-art facility to deliver. Bulls point to the experienced management team that pulled off that tough turnaround, the explosive triple-digit revenue growth. They see it as proof of concept. They argue the market will eventually recognize the significant cash flow potential here, making the current valuation look cheap down the road.
Okay, that's the bull story. What about the bears?
The bear case, in contrast, highlights what they see as extreme and multifaceted risks. Skeptics point to that severe customer concentration as basically an existential threat.
One customer walks, the company collapses.
That's the fear. They argue the headline revenue growth is poor quality, driven by that volatile, low-margin procurement business that just strains working capital and hides the true profitability picture. The precarious balance sheet, with that historically high leverage and poor liquidity, is seen as a sign of real financial fragility.
And they find validation in.
Bears find validation in the flat year-over-year earnings per share, despite the massive revenue growth. They point to the consistent insider selling by top executives and that exceptionally high short interest, all suggesting the stock's meteoric rise is simply unsustainable.
So, two very different stories. Where does our intrinsic value analysis, the DCF, place the company amidst these conflicting views?
Our educational discounted cash flow analysis really tries to reconcile these two opposing narratives. We modeled both the high near-term growth potential, fueled by the AI boom, and the significant risks execution, customer concentration, financial leverage. And doing that, our analysis yielded that estimated intrinsic value range for TSSI of $14 to $22 per share.
$14 to $22. And the stock is trading right in the middle of that range now.
Exactly. As of August 15, 2025, TSSI's share price of $17.62 falls squarely within our estimated intrinsic value range.
So what's the verdict then? Given everything we've discussed, how should our listener view TSS Inc. right now?
Fairly valued.
Overvalued.
Undervalued. Well, its position right within our range suggests that the market, at this moment, is pricing the stock with a pretty reasonable balance. It's weighing those immense growth opportunities against the considerable financial and operational risks.
So no obvious bargain, but maybe not wildly overpriced either.
That's how it appears. The current price doesn't seem to offer a significant margin of safety, which a traditional value investor would look for, buying at a big discount to intrinsic worth. But nor does it appear excessively overvalued, given those powerful industry tailwinds. The stock is really, in essence, a high-risk, high-reward proposition. The current market price seems to fairly reflect that wide range of potential outcomes.
What really stands out to you from today's deep dive? I mean, given those razor-thin procurement margins and the absolute critical importance of that one big customer, how could TSS Inc. truly diversify its revenue streams and customer base without maybe sacrificing its core value prop, that unique speed and flexibility? It's a tough needle to thread, isn't it? Something to mull over.
It really is. Diversifying without losing focus is the key challenge.
Well, if you found this deep dive valuable, we definitely encourage you to like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, absolutely.
Stock Analytics AI members get priority deep dives on tickers for just €4.99 a month. We're planning to cover all the S&P 500 stocks over the next few months, and members get exclusive priority access.
And if you just want a one-off deep dive on a specific company,
You can drop us a super. Thanks. We appreciate the support.
and, of course, the crucial reminder, This analysis was generated by an AI system. It's for educational purposes only. It should not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely critical. Thanks for diving deep with us today.
My pleasure.
We'll see you next time.